Why gas prices aren't dropping. AI analyzes the path to market stability, while geopolitical conflicts often feel distant. Their impact is felt immediately at the local gas pump, with U.S. gas prices currently averaging over $4 per gallon. Roughly, $1 higher than last year. Consumers are searching for a light at the end of the tunnel. When asked to project when oil and gas prices might finally stabilize, ChatGPT provided a sobering outlook. Relief is not imminent, and the old normal of cheap fuel may be a thing of the past. The geopolitical bottleneck, the primary driver behind the current price surge, is geopolitical instability, specifically disruptions involving Iran and the Strait of Hormuz. As a critical global transit point for oil, any tension in this region creates a ripple effect that pushes oil prices toward the $100 per barrel mark. Even if a ceasefire were reached tomorrow, the AI notes a crucial economic reality: supply chain lag. It takes months, if not longer, for global logistics, refinery outputs, and distribution networks to normalize after a crisis. Consequently, price relief follows peace, rather than preceding it. 3 scenarios for the future of fuel prices based on current market trends and geopolitical volatility. The analysis suggests 3 distinct timelines for price movement. The short term, a bumpy plateau, 3-6 months in the immediate. Future, consumers should not expect a sudden drop in costs. Instead, expect a period of high volatility. Risks, summer travel demand and refinery constraints could push prices toward $5 per gallon. Outlook, prices may peak and then ease slightly, but the transition will be uneven and unpredictable. The medium term, normalization, late 2026. If supply routes reopen and production stabilizes, prices could descend to a range of $3.50 to $3.80 per gallon. The demand destruction factor. There is a caveat to this recovery. Sometimes, prices stabilize not because supply is abundant, but because they have become so high that consumers simply stop buying as much. This phenomenon, known as demand destruction, can create a false sense of market stability. The long-term, true stabilization, 2027 and beyond, the most realistic timeline for consistent, predictable pricing is 2027. This is when supply chains are expected to be fully rebuilt and markets have sufficiently rebalanced. The new normal is cheap gas gone. Perhaps the most significant takeaway is the shift in the baseline. Even once the market stabilizes, it is unlikely to return to the ultra-low prices, under $2.50, seen in previous years. The era of ultra-cheap gas is unlikely without a major recession or a massive global oversupply. The analysis suggests, without a fundamental shift in global production or a significant economic downturn to suppress demand, the new normal will likely feature higher floor prices than the previous decade. Conclusion: while prices may eventually settle, the path to stability is hindered by geopolitical friction and supply chain delays. Consumers should prepare for a prolonged period of high costs, with true market predictability not expected until at least 2027.